Hello and welcome to episode 2 of our new tax update series. I'm Andy Rainford, Chartered Tax Advisor and Editor here at Tax Essentials for Advisors. At the start of the last episode, I said that these updates would be fortnightly. However, the next one will actually be available in 3 weeks' time. My son has been asking for a sombrero for several years, and apparently the ones on Amazon aren't authentic enough, so we're jetting off to Mexico next week to satisfy his need. Please accept my apologies in advance, but rest assured I'll pick up any key announcements in the next issue so you won't miss out. This week's episode will again be broken into 3 subsections: general news, HMRC news, and tax cases. A brief summary of what we're looking at this week is given here. So without further ado, let's look at some general tax news. First up, the Institute of Chartered Accountants in England and Wales has issued a reminder about how employers need to treat internationally mobile employees. These are employees that are on a UK payroll but carry out their duties both inside and outside of the UK. It's always been possible for employers to apply for an HMRC direction to restrict the deduction of tax and NI to the proportion of earnings that relate to the UK. However, previously it was necessary to wait until the direction was issued. This could mean employees overpaid UK tax, with the reconciliation done upon submission of the tax return. From April 2025, the employer can operate a reduced withholding as soon as they submit a notification and HMRC acknowledges receipt. This should mean fewer overpayments for affected employees. There is a potential administrative problem, though. As the new approach meant a change in legislation, existing determinations are no longer valid, and new notifications for tax year 2025 to 26 must be submitted. The link for the new forms has been included on this slide for you. Next up, the contentious loan charge. You may recall a popular tax avoidance scheme that was promoted to many accountants and their clients. This involved issuing supposed loans to employees in lieu of salary payments, the argument being that these were not taxable income. The bottom largely fell out of such arrangements following the Supreme Court decision involving Rangers Football Club. This found in favour of HMRC. The loan charge was introduced to recover the tax and national insurance that would have been payable on these loans had they been classed as income. The charge has been criticised as overly punitive. An independent review is currently ongoing, and there is a call for evidence with responses required by the 30th of May. If any of your clients are still subject to the charge, their experiences would be invaluable to the review. Onto HMRC, and first up is a big sigh of relief for employers. The mandatory payrolling of benefits and taxable expenses has been pushed back to April 2027, a 12-month delay. You may have encouraged clients to sign up to payrolling voluntarily. If so, make sure that they understand that the delay only applies to mandatory rollout. Anyone signed up for 2025 to 26 should proceed as planned. A technical note covering significant operational information has been published and can be viewed at the URL provided here. We will be publishing an article in the June edition of our Tax for Professionals newsletter, scrutinizing the detail of this note. On to making tax digital, and next year's rollout is another few weeks closer. HMRC has now confirmed that more than one agent will be able to be authorized to speak to its officers on behalf of clients. This will make sense where there is, say, a bookkeeper making quarterly submissions and a tax advisor making the annual confirmation. There will be differing rights for each agent as shown here. In lighter news, HMRC has published its top 10 tips for registered agents contacting the department by post. The meaningful takeaway is to make the who, why, and what very clear. For example, don't head your letter with the word complaint unless you are making a formal complaint, as it could lead to delays in your client's issues being resolved. A basic but essential point is to ensure you are addressing correspondence to the appropriate address. The URL provided here gives the main addresses for the most common HMRC departments. On to cases then. The first case serves as a reminder that where the VAT threshold is exceeded, the registration date is determined by statute. Where there is a delay in the registration number being issued, your client will still need to account for VAT from that date. They can't include VAT on their invoices without a VAT number, so a potential workaround is to increase prices to collect the VAT in the interim. They should then issue a revised invoice once the number is received. Last up, a land tax case that considered the time limit for replacing a main residence with a replacement one. This took place in my rarely sunny home of Wales. The taxpayer in this case argued that one of the reasons that selling the original property took longer than the permitted 3 years was the coronavirus lockdowns. It was legally prohibited to complete transactions during these periods. It's hard not to have some sympathy, as it was literally impossible for the taxpayer to sell the property concerned during the lockdown periods. He argued that the 3-year window should be extended by the duration of the lockdowns. Unfortunately, the COVID legislation did not provide for this. Nor did the LTT legislation provide for any discretion, so the 3-year window was set in stone. Okay, that's it for this episode. Thank you from me, Andy Rainford, and all of us at Tax Essentials for Advisors for joining. If you're viewing on YouTube, hit the subscribe button below to ensure you get notifications when new videos are added to the channel. Remember, the next episode will be available in 3 weeks' time instead of 2, when my tan will be miles ahead of where it has any right to be for spring. Bye for now.